Coming into crypto, didn't we all imagine that in very little time we'd be sitting in a chair, cool sand on our feet, feeling the ocean breeze, enjoying beautiful blue water? Some of us imagined the feel of incredible soft leather seats as we climbed into the supercar of our dreams. We thought crypto was different than it really is, and we overestimated how fast we could get to something like that in our lives. Now we know that smart crypto investing looks like watching interviews with project founders who are sharing their vision of what they're building so we can make informed decisions what we like about a project so that we can get a feel for what we think about the chances of success are for that project. And then we do additional research to see where their token price is and see if we would be buying low at current prices so that we can hopefully sell later for much higher. Now, this is what the 5% of people who are massively successful in investing do. And if you're here with me to watch this interview with Manu from DeFinity and ask questions and listen to the answer from the questions that you and others ask, well, you're in exactly the right place, and I like it. Welcome to the Crypto Rain channel and our family. Now, I grew up poor in life, almost never able to afford even McDonald's, and I realized that money allowed us options in life. Now, after a few months of being in crypto, when I started 8 years ago, I recognized that there was the most amazing, massive potential for financial gains that will change your life completely. And I had been waiting for this chance my whole life. Now, after 8 years, I know that crypto can and will change your finances and your life, but only if you're doing it right. Something very scary is I learned that 95% of people in crypto don't make meaningful money or flat out lose money. And I didn't want to be part of that. Only 5% of crypto investors make life-changing gains that take them into the lifestyle we all dreamed about as kids. So I focused 100% of my attention on figuring out what those 5% did and then putting that into practice myself. By 2021, using those principles, I was able to fire my day job, move to the city I wanted, and put myself in position to never have to work again if I didn't want to. Now, these principles will do the same for you the better you apply them. Now, if you're looking to be part of that 5% that make life-changing gains, join the Patreon link that will give you access to the Rainmaker private Discord. This is where the best and most valuable information and private discussions for becoming a savage crypto investor and bringing that out inside of you is. So join us there. Now, do note I'm not a financial advisor. I'm not your financial advisor. I'm a crypto investor myself, and I have been an investor for almost 25 years. I'm laying out what I like and why I like it, but do your own research, make your own decisions. What I love about this channel is that I can bring you interviews such as this. My co-host, Randy Chavez, is joining me today, and Manu will be joining us in just a minute. So we'll make it rain on that like button. Help me welcome Randy to the channel as we discuss for a little bit while we're waiting for Manu. Manu just finished a meeting, confirmed to be joining us shortly. Randy, how are you?
I'm doing all right. I'm sucking on the Ricolas and drinking those NyQuil hot toddy things so I can try not to cough on this live that we're doing, and do what you got to do.
Getting sick slows us down in life. Sometimes we forget to be grateful just for like good health until we don't have it.
Yeah. Agreed.
So now you've been a longtime believer in DeFinity. What caught your attention about DeFinity? What, about 2 years back?
There's a bunch of reasons why I get into or I pass on a certain potential investment. Sometimes you have to make the difficult decision and maybe have the hard conversations with the CEO if they're like, okay, the product that you have is good and people want it, but if they don't have the experience to take it up to the next level, or if they don't have the maybe they're good in one thing as like a technical person, or if they're good as a technical person, a lot of times they're not really like a shark. If they're good as a shark, maybe they don't understand certain trends and mindsets. Sometimes that's why you have sometimes, you know, a CEO and a co-CEO, or a CEO and somebody else in charge of that. I feel like for a lot of people in general, you're either a doormat or a matador. And I like to figure out which one CEO is. And sometimes a company can be successful, even if the CEO can be like a doormat, because the product is so good. At that point, you're betting on the horse. Sometimes, even if the product isn't great and they don't have it figured out yet, and the CEO is just a beast, it's like, okay, you're betting on the jockey, and we'll fix the horse eventually. Thankfully, with Manu, I find that, as we were talking before on stream, just very charismatic, has been successeful in banking, having all these relationships for 20 plus years, despite how young he looks. He's been in banking for 20 plus years before getting into crypto. And again, like, so the business side, not worried about it all. Business side is cooking. They're getting that bread. The only problem that we see with a lot of other cryptos is just awareness. And I think that as long as the revenues keep coming in, as long as, like, they'll figure it out eventually, like a doctor trying to figure out, okay, my patient is really sick and I know a certain combination of meds are going to work. We just have to figure out, you know, can the patient last long enough for us to figure out that right combination of meds? And the business is going to be there, I think, for a long time. Even Manu said earlier this year when he was on with us, and doing well into the 6 figures each month. I assume that's probably gone up a little bit. We'll ask him about it. But there's no doubt in my mind that the business will last until they solve the awareness problem, until certain regulations happen, until they're able to do buybacks and burns as they had once said, and they've delivered on a lot of that. So yeah, for me it was a no-brainer. I was like, okay, this will be fine. The company will last up until they could figure out the awareness problem, certain things. So I have no problem continuously adding to my bag here.
Somebody playing on my computer somewhere. I don't know what that was. That was crazy. All right. Well, without further ado, I see Manu has jumped into the green room, and let's bring him up to the stage. Manu, so good to have you here.
Hey guys, good to be on.
How you doing, brother?
Yes, it's been a while. Chris has joined us a couple of times in the last little while. But we haven't been able to have you on a year and a half. You've been busy. I want to get started because there might be a few in the audience that haven't heard what DeFinity is and what DeFinity does. For those who might be new, Manu, what is DeFinity?
Okay, so maybe it's worth, I guess, for those that know about me and I guess the broader firm, maybe it's worthwhile giving a bit of context, maybe a bit of background, just so they have the full gambit really. But in terms of me, I spent about 20 years working in TradFi. I worked for initially Barclays Investment Bank, and then thereafter I worked for the financial market division of Lloyds Bank, so two large UK investment banks. I then left in 2019 to join a fintech called DMA Link, and that was essentially an interbank FX platform. And the reason that I joined that business in 2019 was really because my ulterior motive was to essentially set up a similar model, but for digital assets. So essentially a way of frictionlessly trading basically digital assets in the same way that we trade FX. And that really was the provenance of the DeFinity business. You know, we set that up, we launched that a couple of years ago, and essentially it's gone from strength to strength. You know, we've scaled it reasonably fast, and we're continuing to add bits and pieces to it. We're looking to scale quite significantly next year as well, and we've got some very, very exciting things. I was hoping I might be able to share one or two of those things, but I'm still waiting for one of the very significant press releases to be signed off, which it has not been. So unfortunately, I'm going to have to maybe drop that news a little bit later. But anyway, suffice to say, it's a very big piece of news. But really, the founding tenet really of DeFinity and also of DMA was really to have, I guess, more open, more transparent, and more accessible financial markets. You know, be that foreign exchange, be that precious metals, or be that digital assets. And essentially, the journey that we've been on is quite an interesting one. You know, we found that when we first came into the digital asset ecosystem, there was a lot of people that were, again, very, very smart people that understood the digital asset side, but didn't really understand the banking side. And vice versa, there's a lot of very smart people in banks that understand the banking side, but they're less than savvy when it came to the digital side. And, for me, the real attraction for digital assets was the fact that it's clearly the future. And I guess the real legacy we want to build with the franchise that we have and tend to expand with is to build a conduit for TradFi to access the digital market. Because let's not kid anyone, when it comes to innovation, it is the digital asset market that leads the way. However, when it comes to safety and legal frameworks, it's shit for a long time. So the legal frameworks of TradFi are phenomenal. The systems, the tech, not so much. So if we can combine the two, we have a very, very viable, very sustainable, very scalable ecosystem. And that, I guess, a very, very, very high level, 30,000 feet summary of what we're trying to do and how we're trying to do it, hopefully gives a bit more context to the business and us.
Now, over the past number of, years, we've been talking to you, and we've had, this is probably our fourth or fifth interview over the past 2.5 years. The last couple, like customer acquisition for your business, of finding either sovereign wealth funds or high net worth investors that were able to buy crypto using your platform. For those in the audience, one of the challenges with a lot of traditional finance and investors, high net worth investors, sovereign wealth funds, or institutions buying crypto is they don't want to hold it on their, they don't want to hold it in their own private keys. They're not going to hold it on an exchange. And so DeFinity solves that problem for them. So they can literally trade without having their assets sitting on an exchange. They can have their assets sitting in a bank that they trust, that they probably already do business with, and they can trade against those funds. So they can have their money custodied in a safe place, rather than, say, having it sitting on FTX, which may or may not be being siphoned off by the investment arm of it. They want to hold it somewhere safe, and they have a fiduciary responsibility to have it somewhere safe. So with Manu's background in banking and finance, he was able to recognize this problem and create a solution that's been solving it for a while. And you've been gone live with it for past almost 2 years, and your customer acquisition has been amazing. Last time we spoke to Chris, customer acquisition was still going great. How's it been going since then?
Yeah, it's been phenomenal. It's been very good, very positive. I've got to admit, we as ex-bankers, which I don't know, I'm not quite sure I like that. Ex-TradFi guys, I'm not sure about. I don't know which I like less, but I guess we've been around the block. We've been working in traditional banking for a long time. So yeah, we're not great at shouting about what we're doing, about how awesome our approach is. And what's quite interesting is that we have had a lot of our existing clients that have introduced people to us, and word of mouth recommendations, I've got to be honest, are probably the best thing that we've ever had. We've delivered on a service. We basically said, we will do the following. We have delivered on those things, which begs the question as to how unprofessional most people are in this market, which is kind of crazy. We just do our jobs. You told us to get this done by this time. We've done it that time. We've done what you asked us to. We don't expect any huge gratitude or thanks. We're grateful you want to do it with us. So we just delivered what we said, and we didn't lie to people. We didn't bullshit people. We didn't make up excuses. We've said, yes, can we do this same day? Yeah, given the time zone, absolutely. If it's Aussie, probably not. Singapore, probably not. If it's US dollar, absolutely, no problem. And we've just kind of been honest and open with people. And look, let's not kid anyone. Shit goes wrong. Things happen that are out of your control, like the bloody AWS outage, which took out half our banks. Nothing we could do about it. So we were on the phone to our guys saying, hey, listen, guys, really sorry. We're not going to be able to settle these trades today because our correspondent bank, we can't log in. And no one's picking up the phone, and they're all panicking. So look, why do you safeguard it? It's a top 20 European bank. Nothing's going to happen to it. You've got to bear with us, until the AWS thing blows up. The next day, everything cleared. We settled it, went through fine. So I think because we've been very open with people, we've been very honest, and we've just told people the truth about, good and bad. When good things happen, we pick up the phone and say, hey, we've done the following in advance of what we said. It's good, but I think that's been the key. We've just been very honest with people, and I think that's the key thing. I think there's a lot of people that go out there with the best intention, without fully understanding what they're signing up to. And the easiest way to piss people off is to promise them everything and deliver on nothing. And we have a lot of conversations where clients, they don't necessarily get upset, but they ask us to do transactions. We look at it and just go, it just doesn't really work. Either it doesn't make enough money to justify the risk, or it's just too challenging, or realistically, it's just too complex a deal and we can't guarantee that it's possible to do. And we just tell them the truth and say, look, maybe there's someone else that can do it, but it probably isn't us. This is what we do. We're very specific about the box that we're in. We do the following really, really well. This is outside the box. We can't really fulfill this. And so we're not going to commit to it. And I think, saying no may piss them off initially, but they usually come back and say, look, thanks for being honest and not wasting our time. With weeks and weeks of conversation, they go nowhere.
Yeah. So if I were to summarize, client acquisition was going great. You haven't even needed to advertise, just word of mouth. People are telling other people that deal in that sphere, and you're getting phone calls from them and continue to acquire new clients.
Yeah, absolutely. And look, I think if we look at the provenance of how we've kind of evolved the business, what we've done to try and scale and grow this business, we've just listened to what clients have said. They've come back and said, hey, we have the following issues. Do you offer these currencies? Which at the time we didn't. And they said, look, we'd be interested in doing this. So we kind of did the math and said, okay, we could do this. Suddenly out of nowhere, Turkey's not doing particularly well. I can see why they want to trade that market. So we kind of looked and said, we did the maths. Okay, is it worth doing? Okay, yeah, it is if we're doing X million a day. If we can justify the cost, yeah, of course we'll do it. So likewise with the repo idea as well. Again, that was a pension fund that approached us and said, I want to get exposure to a digital asset, be that Bitcoin, be that ETH, but I don't want to hold it. I don't want to touch it with a barge pole because I'm not allowed to, and I won't be for the next decade. But I want to have an enhanced yield for helping put liquidity into that market. How do we do this? And that's kind of the provenance of the crypto repo idea that we hopefully will very soon have a very, very major press release about. And I really was genuinely hoping I could have got that signed off today, but sadly, I have not got that signed off. It's in the hands of some very large banks, and yeah, they've been sat with this for about a month. So I'm hoping, fingers crossed, in the next week or so, certainly before Christmas, they sign off. We can release that and talk about that in more detail.
I haven't seen the last interview or so. Can you share with everyone about Bloomsbury Money?
Yeah, sure. So look, again, this is another thing that came out with conversation with clients. Because we deal with a lot of very large banks on the DMO side, on the FX, the interbank FX business. A lot of them said, look, you guys seem to have a lot of connections at a lot of banks. Why don't you just set up your own banking division off a bank account? And we just kind of said, well, we don't really do that. We're not, we were kind of more wholesale banking, not really retail banking, not really our thing. And by the time we got to the 30 or 40th clients that said, hey, we'd like to set a bank account, we're like, maybe we're missing a trick here. Maybe there's a better way of dealing with this. Maybe we should look at this and see if there's something we can actually do. So we did. We spoke to a couple of our relationship banks and said, look, hey, hypothetically, if we were to set up an offering where we offer bank accounts to some of our clients, what would your view be? Would you support us? And would you believe every single one said, yes, we would be delighted to support you, which we were very surprised by. But I guess because we've been doing business with these firms for quite a while and we established a reasonable amount of credibility, probably wasn't that surprising. So we launched that business really to offer banking for, I guess, principally digital asset businesses, so obviously higher risk businesses. But really, there's a couple of iterations. So the first iteration that we've launched just now is purely fiat banking. There is going to be a second iteration of that will be launched probably beginning of Q2 next year, maybe Q1, depending on how well the tech goes. So at the moment, it's pure fiat banking. So again, it's got embedded FX from, again, some tier one banks. You can do payments, you can do whatever you wish with a normal bank account. It's a very slick app. It's been pretty well designed. The final iteration that we have that's going to be released next year is phenomenal because that is a full stack fiat banking and crypto banking all in one. So again, you can custody your own digital assets, you can on-ramp, you can off-ramp, you can do digital to digital, you can do whatever you wish, all within the comfort of one app. And then if you want to make payments, you can send outbound payments, receive inbound payments, you can send digital assets to whoever you wish, basically, that you can whitelist using the wallet architecture. And again, from a safety and security perspective, we partnered with a firm called Utila. They are basically running the back end from the crypto custody perspective, because again, look, we're very good at what we do, but we are not the guys that are the champions of encryption, and these guys are. So this is they do this for banks and hedge funds on a regular basis. So we partner with them to essentially to run that piece of the puzzle, just to make sure that everyone's digital assets are secure. And then from a banking perspective, your risk is not me. Your risk is basically one of our banks that will basically be safeguarding your fiat assets. So effectively, your funds will be sat with a tier 1 US bank or a tier 1 European bank. So they'll be hosted in London, and essentially you can be totally comfortable that your funds are safe. They're fully protected. They're ring fenced. We can't touch them. We can't do anything with them. They are your funds. And you are free to use them as you wish, basically. And of course, it will be crypto friendly. Of course, that's the point of the whole thing, to make it crypto friendly. And we think this is going to be a pretty big game changer as well for the industry, because I know there's a lot of banks that kind of exist in this ecosystem that purport to be crypto friendly, but they're not really. Whereas the view we've taken is that actually there's a huge latent demand here, that's not been met. And one of the things that we spent a lot of time and effort doing was sitting down with the risk and compliance guys, the banks, and saying, look, you've got to understand that this crypto stuff is not this anonymous internet money used by scammers or fraudsters, which is what they all think intuitively. You look at Bitcoin, you look at ETH, you look at stables, be that USDT, be that USDC, running on any one of the 14 blockchains they run on, they are the most transparent things on the planet. They are the most trackable, the most traceable assets. So actually, you can look at behaviors via blockchain analytics, and it's very easy to determine, are these bad actors? Very, very easy. Much easier than the fiat side. Because yes, you can see the payment that's coming to you. You have no idea where those funds came to before you, unless you go back to the previous correspondent bank and the bank before that. That takes some doing. So once they get their head around this, they realize that you can use the digital asset business to really judge whether this is a good or bad customer. And I think that gives you a level of sophistication in decision making and kind of assessing risk that has never existed before. So once they realized this, it became much, much easier for them to say, actually, you know what, this kind of makes sense as a business. We like the idea, because actually we didn't position it to say we want to be crypto friendly for the sake of being crypto friendly. We positioned it to say, if you really want to see how risky a client is, allow the digital assets side of the business to exist, and you can get a very, very inside scoop as to what the true nature of this business is. What are their risk and controls? How does their governance framework work? And how savvy are they in terms of managing their own exposure to, for instance, tainted coin? And if there is taint, where's it come from? Is it intentional, i.e. they're bad actors, or is it accidental? So that was a challenge. That took quite a long time to convince them with. But once we managed to get over that initial hurdle, they were very open to the idea.
Well, yeah, the traceability of crypto, so that everyone will be able to see all my funds come from all the drug money. Like, what I mean to say is all my selling of Tylenol and Motrin. No.
I think Tylenol's regulated. That's fine. That's absolutely cool.
In the banking field, so what you're saying in the banking field is now, because the traceability of money through crypto, like they just have a better idea of, like, are they dealing with a good actor? And that gives them a higher level of security in what they're doing. Is that
exactly. So I think the initial view was there is a fiat leg, which we see. We understand this. We can put that through our transaction monitoring system. We can see what's happening. We can monitor it. And then there's this black hole, which we don't understand. And we can say, look, that's just not correct. Actually, that's not a black hole. That is a huge window into the true nature of this business. If they're telling you they're doing trades with the following counterparties in the foreign jurisdictions, you can see, actually, are they? Where are these wallets hosted? Who owns them? What kind of trading they're doing? Are these volumes stacking up to what they're saying? And it takes just literally 10 minutes of analytics to work out, actually, is this a legitimate business or is this not? And once you demonstrate that a few dozen times, the penny drops and they go, shit, this is actually very, very sophisticated.
I love that. Because it gives good actors kind of a better, it's almost like a credit risk score of how risky this business.
Exactly. And don't get me wrong, there's a lot of people that will be owed capital from people and they'll say, hey, I'll just send you some stables. And because there are some, they'll send tainted coin. It's to the best of us, there's nothing you do. Yeah. But when you have a conversation with them and you're trying to say, well, is this, and you don't care about how you have those conversations, but is there something there that's nefarious, or is there something that's happened accidentally? It's very easy within a 5-minute conversation to work out what has truly happened in error and what has happened, I guess, because there's something behind the scenes that shouldn't really be there.
So speaking of stables, I'm sure you have heard about Tether and the realization of gold. They had bought an insane amount. And I was wondering for you guys, because you guys are doing really well, almost like a cash cow. What happens with those funds? Where are those allocated? Do you guys also buy gold in order to keep on your balance sheet? Do you keep it in other stables?
So I need to talk not too loudly, otherwise the sales guys will book another trip around the world to see clients, which which I don't want to have happen right now. So look, we do a couple of things. Obviously, we're spending a lot on doing R&D. We're basically building quite a lot of tech basically in house. So for instance, one of the things that we have tried to do is, because we have obviously a lot of clients, we have a lot of bank accounts. Sometimes it's quite difficult to work out what is the actual position of the book on any given moment. So what we've done is we've built our own tech stack whereby effectively we've just built API feeds to all our banks and to all our digital asset custody wallets that we have, and they all kind of come into a main blotter. So every inbound transaction, be it fiat, be it digital, you can see every single one on the screen. You can click on the screen and you can allocate it to people. You can basically, has the trade been settled, has been booked, who's allocated to, and it kind of all auto routes. So we've basically done the heavy lifting and allocated it to certain clients. They've all obviously their own wallets and everything else. And it's just a really cool reconciliation tool. What we built it because nothing existed in the market. And speaking to some of our liquidity providers, it sounds like there's a lot of crap on the market that doesn't work very well. So what we have seems to be quite interesting. And then obviously, we've been spending quite a lot of money on our own tech stack. The full fiat banking, the full crypto banking has been where we've been putting a lot of the capital. And again, look, I'll give you guys hopefully a bit of a sneak preview of this at some point soon, so you can have a look at it and maybe play around with it. And again, feedback will be very welcome. But it's a very cool platform, and hopefully we can get this out into the ether. But I think that's where the majority of it is. Obviously, we hold stablecoins. We did have a reasonable position in crypto. I'll be really honest with you. Our models are looking for a bit of a challenge next year. So we're looking for a pretty big correction, unfortunately, but it's only temporary. But yeah, we're looking for a pretty big correction next year in mainly Bitcoin, to a lesser extent ETH. So as a consequence of that, we've kind of maybe reduced our exposure by about 50% to Bitcoin and ETH as a consequence of that. I wish I'd done it 120, but
So as you
94 is better than 120, I guess.
Yeah.
In the past, you've mentioned that the thought went out of my mind. We'll go with this one. You have as an investor, to hear you say that, hey, we have our own tech stack, and this is at least in the US, if you invest in R&D, anything that you invest into R&D, you don't have to pay taxes on. Let's say if you had $1 billion in net profits, if you put that into R&D, you actually don't have to pay any taxes, which is really cool. Is that similar to what you guys have over there in London and for this R&D? Yes. Okay, awesome. I see why we're going hard with it. The models that you're talking about, is that from Axion AI, those models that we're talking about the big correction, or is it from something else?
It's a combination of a couple of things. It's a combination of a couple of things that I can talk about, a combination of a couple of things I can't talk about. But the long and short of it is this. So if you cast your mind back to the late 90s, there was a stock I had a huge position. And again, look, I was a fairly young chap. I was at university, a little bit clueless, but obviously in the mid 90s, I've been buying stock, and in a bull market, any idiot can make money. I thought I was Warren Buffett. I was like, pretty awesome. This stock market stuff is great. Now, I actually began to do a bit of proper research. I was looking at this company. I thought, I like this business. I think it's cool. I think this could be the future of commerce. And in 1999, that company fell 91%, and that company was Amazon. So I sold like an idiot. When was a good time to sell Amazon? Never. But what that was a bit of a phase shift, and that was when the market realized that the future of e-commerce, well, actually there was no e-commerce. So the future was e-commerce, and that future was the internet, and that was this business that was kind of encapsulated by Amazon. So yes, it started off as basically being a bookstore, then it started off as selling other people's stuff, and then it became a bit like, I guess, a combination really of that and eBay. And what typically happens when you see these phase shifts in these markets is you have essentially what I like to call the wash and rinse. You see a progression, essentially a progression of rallies higher and higher, and then you basically see almost it's kind of like almost a vertical collapse of that market price. And that really, the purpose of that is really to get rid of the weaker hands. And that is kind of what happens when you see a transition from a existing framework of markets to a new paradigm. And that's kind of what happened with Amazon. I think the same thing is going to happen with digital assets. So the correction we're looking for next year is not the end of the world. It's not. It basically means that the market is finally ready to embrace the digital future. That's what this is. But I don't know whether that correction is going to be 30% or 50% or 90%. I have no idea. But I suspect it's going to be very similar to 2014. So I think it's going to be a similar pattern. Hopefully not quite as pronounced, but it's going to be a similar pattern potentially to that. And if you look at a lot of the things we're seeing, I was kind of waiting for the flipping. I was waiting for ETH in terms of market cap to take over Bitcoin. It didn't happen yet, but we're speaking to half a dozen banks, half a dozen European banks that are launching, or have launched some of them, their own stablecoin. Every single one runs on Ethereum. So it's just a matter of time. I mean, obviously, the first iteration by, who was it? I think it might have been SocGen or BNB, I forget, one of the French banks, was pretty shit. But it was the first version. They'd never done it before. They didn't know what they were doing. It was crap. However, they've learned from what they did previously that the way they built their tech stack was not great. Their smart contracts sucked. Sat on top of that. They were just not very good. Learned from that, and they've realized actually we should really issue our own stablecoins, and that's kind of what they're all pushing for. So I think that's going to be another driver for greater use of Ethereum. And don't get me wrong, Bitcoin's still going to be a $1 trillion market cap. It's just not going to be the biggest one. It's going to be ETH. Now, the big question, and this is where potentially there's a lot of money to be made, is that all the banks have to have a backup layer one. So which third generation layer one is it going to be? ETH is obviously taken, but what's the next one? Is it going to be Cardano? Don't know. Is it going to be Solana? No, definitely not going to be Solana though. That's down at least once a week these days. It's probably not going to be Tron. And I think the reason for that is probably just, I guess, because it's Chinese. And
I don't know anyone that uses Tron. I don't like. I don't.
Really?
Yeah.
Really?
Okay.
Well, it's done a great job with Tether. Really, sending and receiving Tether has been their great use case for Tron.
Their only use case, right? Arguably.
Yeah, that is the use case. But who's going to get that? Maybe it's going to be Sui. We'll see who takes the second place. But for those of you in the audience that don't know, banks have to have their primary layer one that they're going to use, and then a backup layer one that they're going to use. And so we're just trying to figure out what that backup layer one is. But what a lot of people don't realize is so much is being built on ETH. Like ETH hasn't even hit its previous cycle highs. I think there's a lot of upside potential, and that's why, who's it? Jack? What's the guy?
Jack Mahler?
No, not Jack Mahler.
Or Tom Lee. He's a big ETH guy.
He's been really big talking about how it's the major trade, and he's awesome. I'm talking about blue chips, but he thinks Bitcoin's going to go to 250,000 in the coming months, and that ETH is going to have a bigger upside than that. He thinks ETH might go to 30 or 50,000. And behind the scenes, we are seeing so much institutional adoption of ETH. Manu actually has good insight to that because he's talking to all these banks, and like you just shared, they're all building their tech stack on ETH. And I think a lot of retail investors don't realize that, like how much is really going on behind the scenes with ETH. And you probably won't realize it till a lot of that happens. One of the other things, what about using XRP as their backup? Because I know the financial rails of so many of these things are being built on XRP for transmitting funds. Are you seeing any of them discuss XRP for building their own tech stack on?
Yeah, okay. So I am, but not in Europe. So we, again, look, I spend most, if not all, of my time kind of in Europe, and basically the banks that we deal with, the banks that we know well, are either based in London or Frankfurt or Paris. That's kind of the majority of them. I've met a couple of banks that are using it, but they're all Asian. They're not European banks. So it seems to be that XRP seems to be embraced far more in Asia than it does in Europe. The US banks have been so out of whack and so out of kilter with everyone else that we spend a lot of time speaking to them. And obviously, look, JP and Goldman's obviously have been doing this for a while. They will not tell. Every time we speak to them, we give them a load of info. They tell us jack shit. So in the end, we just stop talking to them. If you look at the other guys, I know Bank of America must be working on stuff. I'm 100% sure Citibank are. I just don't know what they're doing because it's not being done in London. It's being done, well, probably Miami actually, but it's being done in the US. So unfortunately, I just don't know. So with the limited exposure I have, yes, XRP seems to be a big one, but not for Europe. I would say it's the Asian banks, maybe the US banks, but I don't honestly know.
Interesting. Chris can read my mind. Him and I channel like that. Tom Lee was who I was thinking of.
Yeah. Asian Michael Saylor. He goes hard.
Yeah. Now, so to do what DeFinity is doing, you built kind of a gateway so that a lot of institutions, sovereign wealth funds, and companies, they can buy crypto without having to have their money on an exchange, which would be a risk they're not willing to take. And in some regulatory environments, they can't take that risk. But you build a system where they can hold it with a bank that they do trust. They can then trade against that. So then they have access to crypto without having to necessarily, in many cases, custody the crypto, or have their funds at some institution they don't trust, which would be like a crypto exchange. They can have them at the bank they trust. Additionally, you've been talking about other avenues for the while, but one I have a hard time wrapping my mind around. You talk about the repo market, and I'm like, you know, repo for me is like what happens when you haven't paid your car for a while and they repo your
That's
car.
a different kind of repo, yeah.
And then the other one is like the gambling, that some people in the casinos or the gaming that have come to you and like, well, we have this problem. We have high net worth people that want to come in and they, you know, they don't want to travel around the world with $5 million or $10 million on them, and banks take so long to transfer it. Can't they just like bring in Bitcoin and trade or somehow use that to access their funds? Well, what's going on with those two sides that you can talk about?
Okay, so again, okay, look, on the repo side, we have got some big news coming out, and hopefully I can share that with you very, very soon. But suffice to say that we have done the world's first reverse repo using Ethereum, which again, I hope I'll be able to share more details about who we did and how we did it. And then again, we're working on a part 2, which will be the world's first reverse repo with Bitcoin as well. So essentially, a reverse repo, the repo in the repo market stands for repurchase. So effectively, if you think about the repo market, you know, what is it? It's effectively pawnbroking for banks. So you're a bank, you need to have a certain amount of capital. You don't. It's the end of the month. You'll get fined by the regulator unless you've got the right amount of capital in your bank account. What do? You have a shit ton of bonds because you've got a regulatory requirement to hold them. You basically then say, look, how about this? How about you, pension fund? You lend me $1 billion. I give you 1.05 billion bonds as collateral. So if I don't pay you the $1 billion back, you sell my bonds. That's basically a repo from the perspective of a bank. From the perspective of the lender, that's a reverse repo, i.e. they're lending fiat to this counterparty and they're taking bonds as collateral. So what we've done is we've taken the documentation, which is called the GEMRA documentation, which is the framework that essentially governs the repo market. And we've added initially 2 elements, but actually you could add whatever you want to it. And those 2 elements are ETH and Bitcoin. So instead of bonds, you can use either Bitcoin or ETH. Now the haircuts are significant, and really the idea came to me when I was speaking to basically a client of ours that runs a pension fund, and essentially he was saying, look, you know, we're looking to kind of chase slightly higher yield. We're looking for, you know, maybe 7% gross fees, and the net of fees, you know, maybe 6.5%. And I said, so what are you buying? He said, oh, junk bonds. I was like, that's just utter shit. Like, you know, what's the market cap of the biggest junk bond? Probably Ford Motor Group senior loan note. What is that? 500? No, maybe no, probably not even that. No, it's probably about 50 billion. It's tiny. It's absolutely minuscule. So I said, what if I had a market that had $1 trillion market cap, and instead of paying you 6.5 or 7 gross, it paid you 10? You know, would that be interesting to you? And he said, yeah, absolutely. So that kind of how the whole process started. Now, obviously, one of the things we had to do was, when we were working with a firm in Jersey called Concert One. Those guys, very, very smart chaps. They've been in the repo market for a very long time. They managed to convince a lot of the participants to lower, because the minimum transaction value is $1 billion. Very, very limited. So unless you're a Pfizer or a Walmart as a corporate, it's quite hard to kind of get into that game. So initially it was lowered to $10 million and then subsequently lowered to $1 million. Which means it can be accessed by regular corporates now as well. So what this allows them to do, and this is the beauty of the repo market, because you may think, well, you know, if I'm going to lend money to a bank, why don't I not just do a bank deposit, right? A lot easier than the repo. And the reason for that is that in 2014, the good wholesome government in the UK and the European Union and the United States and Canada and Australia and New Zealand passed the bank bail-in legislation. Now, it was worded differently, and it's probably got a different name in the US to what it has in the UK. But as a consequence of what happened to the likes of Lehman Brothers in the financial crisis, if a bank goes bust and steals your money, that's not good. So let's say, for instance, I don't know, hypothetically, let's use a bank like Barclays. Let's say Barclays is going to go bust. If they steal your money, that's no longer allowed. You know, they can't just steal your assets. However, if they take your money and give you their stock, which if the price is collapsing is pretty much worthless anyway, that's okay under the bank bail-in framework. So you, as the depositor, will bail in the bank with your cash, and in return, you get stock that's worth almost zero, which is great. Now, if you did this as a repo, guess what? You're outside of scope of that framework. Your money is ring-fenced, it is protected, it cannot be used to bail in the bank. So it's actually safer. Not only that, but because it's a repo trade, it counts as tier 1 capital. So if you have a bank deposit for more than, I think it's 180 days, you can take that cash and you're going to apply it to your bank tier 1 capital. Or even if you do a 1-week repo or even an overnight repo, you can take every single penny of that cash and apply immediately to your tier 1 cash. So you don't have to tie up client funds for a very long time to have the same effect. So and so what that means is the banks will probably pay you a slightly higher coupon, not a lot, but slightly higher, maybe 10, 15 basis points more to do a repo trade rather than a bilateral deposit. So there's interesting benefit. Now that we have got the capacity to do this with either Bitcoin as an ETH as the collateral piece, it opens the door to a whole bunch of people. So for instance, pension funds are not allowed to hold Bitcoin. And by the time they do, it will be 10 years from now. But they can actually benefit from the yield of Bitcoin today by entering into this transaction. So it's a really novel transaction. It's a really, really cool piece of tech. And I think what it does is it then has this colossal funnel of liquidity that can be pushed into the digital asset market.
There's
Go ahead, Randy.
About 40, just a couple minutes before we went on, it came out that President Trump was considering eliminating taxes on gambling winnings, which is great for everyone in the US. Can you tell me, like, for the idea and the option of this idea of holding a certain amount of Bitcoin and getting casino chips, what country you might roll that out in first? Seems like the US would be good. You can, great. Or is it gambling is legal most places in the world? Just tell us a little bit about where.
So yeah, look, so I will have a really, really major update on that probably in the next week or two. I'm hoping before Christmas, maybe in Jan, but yeah, it's going to be, I mean, it's a real big one, by the way, a very positive one as well. So we're speaking to a couple of casinos in the UK, obviously, because it's where we're based. We have been speaking to a bunch of casinos in the US. We did a small beta test, obviously in a jurisdiction that is not exactly renowned for gambling, right? But it was a US jurisdiction and it worked very well. Very, very small transactions, but we did that. Everything went very smoothly. Everything worked. Tech was very cool, and you know, everything went through smoothly. So we're going to potentially do this in a state that's a little bit more famous for gaming, with a casino that is a little bit more famous than the one we used. That'll be a big deal. And again, what we're going to try and do is ensure that we'll make it very clear that anyone who is a DFX token holder will get a 5% discount to whatever that rate is as well. Oh, and sorry, I forgot to mention, just regarding the Bloomsbury banking solution as well, anyone who holds $10,000 or more of DFX tokens will get free banking. So you will not pay any fees, apart from obviously whatever wholesale fees. You know, if I'm charged $5 by Swift to make a Swift payment, unfortunately you've got to pay it because I've got to pay it, but you will not be charged any spread on top of that.
So can you talk about the difference between what the fees would be if you didn't hold DeFinity versus what they, obviously they're free, but what would they be if they don't hold DeFinity?
For the casino repo, so effectively it'll be a reduction to the lending margin. So the lending margin may, depending on, the lending margin may be 5%. So you get basically, let's say, 50 basis point discount effectively on that lending margin. So instead of 5%, it'll be 4.5% or whatever. If you do the maths, and again, the minimum transaction value with this, because again, this is aimed at ultra high net worths, is $1 million. So they're not small amounts. They're reasonable.
So
Those are also the ones that are more likely going to want to use this because they don't want to fly around. Like many of them fly private, but they don't necessarily want to be carrying around a suitcase full of cash of $10 million. It's just a risk they don't want to have, but they'll often gamble with that amount. It's just then they run into the complexity of how do I have that kind of amount at my, they're in, say they're from wherever in Europe and they want to fly to the US and game. They don't want to fly around with $10 million of cash, but they might want to gamble against $10 million of cash. And if they can use Bitcoin to get access to that liquidity, great, easy.
Absolutely, absolutely. And again, look, I've got to be very careful to kind of point out that, one of our investors maybe raised this and said, look, what is the purpose of this? Are you telling me that it's Saturday morning, it's 4 a.m. and they can't get an access to their ATM? And I was like, no. That's completely the opposite. That'd be very negative as a concept. The purpose of this is that you have to go through your onboarding process. That is going to take 72 hours. This is going to be done well in advance of going there, right? So what would happen would be that you would onboard through the process. Again, on the assumption you passed, everything kind of checked out, the source of funds, proof of funds, everything was okay. You would then send your initial collateral amount prior to going to the casino. And essentially those assets will be, technically the term will be available for sale. And then you'd be given a liquidity facility to then gamble for the duration of your stay. So it's not, just to be clear, this is not something that's spontaneous. There's not something that happens there and then. It could be, but I think that's the wrong way to do this. I think we've just got to be careful that we don't push people into doing things that, quite frankly, are a little bit negligent. I think this has got to be something that it is, from their perspective, a more of a safety transaction than anything else, i.e., the safeguarding of assets, the safeguarding of large transactions to make sure, again, like I said, cash is not exactly ideal to be taking over borders, certainly, but again, also there's all sorts of legal disclosure. You can't come into the United States more than $10,000 of any assets, be that Bitcoin, be that cash. However, doing it by this way, you'd be sending that to a custody wallet that would be domiciled either in Jersey or in Mauritius. So it wouldn't actually leave that jurisdiction, it would be staying there. So it's a different way or a different lens of looking through this particular problem. But again, if this hopefully goes the way I hope it does, then this will be a real big deal. And again, look, hopefully we can do some marketing with some of these casinos too, which would be cool.
Makes some sense. I want to get to some of the questions here. Chris, you kind of answered this, but Chris's question, how is the bank model coming along? Is the institution that was going to participate ready to go?
It is, but the challenges we've had in terms of scaling that model is that we've done the initial test phase. Everything has been very good, but with the test phase, it was a very small cohort, and it was literally just transactions where we're buying, we're then selling. They were very, very small trades, so it was nothing major. The real heavy lifting, I think, is on the scaling of this. So I guess building this to a point whereby we can really scale this in the same way or the same order of magnitude we've done with the electronic trading business or the OTC business. That's the challenge, and that's the bit that takes a little bit longer to do. Because at the moment, when you do a transaction in one Bitcoin, what's your risk? Your risk is, and let's say 5% volatility over the course of a couple of hours of trading. It's not a huge amount, right? When you're talking about 10 million, 50 million, 100 million, a billion, that becomes quite significant. So it's really about getting their heads around getting their heads around and making sure they're all comfortable about the actual risk profile. What is the effective exposure of doing these kind of transactions? What's the worst case scenario? And that's where we're not necessarily struggling or having a hard time. It just takes a little bit more convincing. If your maximum loss is a couple of $1,000, no one gives a shit. If your maximum loss is a couple of $1 million, that's a very different conversation to have. So it's about making sure they understand what the true risk profile is. So when it comes to trading, you have effectively your potential future exposure, which is kind of your absolute worst case on a given time trading horizon. But then you also have your effective exposure. Well, realistically, what's it likely to be? And when it comes to things like Bitcoin and ETH, the potential is very high, obviously, because if you look at historic volatility, even though it's come down, it was pretty damn high. But if you look at the effective exposure, what is it actually likely to be? It's an absolute fraction of this. So it really is just making sure that they understand what the true risk profile is. And I think the only way we can do that is, I think, by scaling very slowly and making sure that everyone's happy and comfortable. But again, there's a lot of people within banks that will need to go through this process and sign this off in order to get this to a position where we can scale this.
Great. F. Fowler asks, hi, Jane Manu, does DeFinity have any plans to bring awareness to the token to the retail crowd?
We do. So essentially, look, if you look at Bloomsbury, that essentially was a bank that was only really for corporates and ultra high net worths. But it will be crypto friendly, and it will have very, very good rails, tier one banks. It will be crypto friendly. It will have phenomenal FX, and it will also have the ability to custody digital assets to basically on ramp and off ramp, and then to do digital trades. Obviously, behind the scenes, powered by DeFinity DMA. That's phenomenal. That does not exist today. Nobody offers that. Now, if you're a regular retail investor, you cannot access this unless you either have net tangible assets of more than $25 million or you hold $10,000 at DFX. So we will market this quite heavily as being something that you can access. And again, look, maybe that threshold of $10,000 is too high. I don't know. We need to think about an appropriate level. But I think if you are interested in accessing that, then this is a phenomenal way of dipping your toe in. So if you want to do transactions that are significant, so if you're looking to do large on-ramps, large off-ramps, I can guarantee that you will have all sorts of issues with your banks, because we hear this from our clients on a regular basis. So you want to do a $500,000 trade with Kraken, good luck with that. It's not going to happen. Or if it does, or with Coinbase, it's just not going to happen. Or if it does, it's going to take forever. It's sure as hell not going to happen in seconds. And that's the difference, because if you do it within the ecosystem, we've built it in such a way that you can then on-ramp and off-ramp within 5 minutes.
There's been a bunch of acquisitions this year that everyone has been shocked by. XRP kind of buying everything. Hidden Road, they buy a bunch of stuff, and then more recently you've had Netflix try to buy WB, and then Paramount being like, nope, yoink, and then they go in and they go directly to shareholders, offering like I think 10% more for their shares. And it's become really cool. Have you guys, because you guys are kind of a cash cow, have you thought about acquiring any other companies, whether it be for their tech stack, for their employees, for the community, or on the opposite end, having be like, you know what, we have these companies, we could just use this tech and we could sell this company, raise a bunch of cash, and then move everything that we have, including DeFinity, over to another?
Yeah, so absolutely. We have been approached. This is the funny thing, is that I remember 5 years ago when I was pitching VCs about this, I must have pitched, and by the way, let me make the big distinction. These are UK and European, not US VCs. US VCs are awesome. Well, they're not awesome, but they will give you money. They may not be very awesome with what they make you do with the money, but they at least they deploy the cash. They're willing to take risk. The European guys are idiots. The guys in the UK are kind of halfway in between. They're kind of, some of them are morons, some of them are actually quite astute, but just, I pitched maybe 115, 120, I forget how many, but every single one said, nah, you're an idiot, it's never going to happen. This crypto shit is a scam, never going to go anywhere. And these same people are now coming back saying, oh, hey, listen, we'd love to, like, why don't you come and have lunch with us? I was like, dude, I barely have time to speak to my investors. I barely have time to speak to people that are actually been very helpful for us and took a bit of a leap of faith and put their money where their mouth was and invested in us. Well, we just had this idea. Why do I want to spend my time and effort with someone who didn't give two shits back then, and now we're making profits? Suddenly you're like, hey, we want to be part of the ecosystem. So it's kind of, and again, I don't want to be an asshole about this and say, go screw yourself. I was very polite to say, look, I just don't have time unless you have something compelling. I don't have time. I'm happy to have a call, happy to grab a coffee, but I can't take 2 hours to have a boozy lunch with you to discuss what you may or may not be able to offer us. But what's interesting is that some of those firms have kind of come forward to say, look, would you be interested maybe, an exit? And I was like, well, it's probably a bit too early for that right now, but it's interesting that they're saying this now. So I think there's going to be some very interesting opportunities in the next 12 months, because if I'm correct about the correction in crypto, that's going to be very interesting, because there's a whole bunch of VCs that have raised large amounts of dry powder that will need to deploy next year. If they don't deploy the money, guess what? They have to give it back to investors. That's not going to happen. So they're going to have to find somewhere to put it. So if there's going to be a smaller pool because of that, and again, I guess the only thing I'm slightly worried about next year are the people that are using their own balance sheet for crypto lending. That's going to be a problem, I think, because if you see a big move, they may not have enough collateral and they may have to liquidate. And if they do that, that's going to be a horrible self-fulfilling prophecy. That could be an issue, I think. I'm hoping that doesn't happen. And look, I'm hoping that it's a small correction. I'm hoping it's a 30-40% correction, not a bloody 80% correction. But I don't know. I don't have a crystal ball. The other thing I think also that's worth bearing in mind is if you look at the Ponzi scheme that is NVIDIA, which is, hey, tech guys, there's this new piece of kit. It's called a GPU server. It's $700,000. But don't worry if you don't have the money. We'll lend you the money, and then we'll take the GPU chips as collateral to lend you the money. What could possibly go wrong, right? That's going to have a very horrible ending, I think. And I think we're going to see some real challenges in AI just as a consequence of this. Although I love what Trump said the other day. You can sell chips to the Chinese if you give 25% to the US government.
Yeah. And then China's like, no, we don't need the chips. It's insane.
It's incredible. It's absolutely, they do need the chips, but it's
what they
phenomenal.
do, they're just going to try to, now China's going to try to circumvent by using inferior products or, you know, that are homegrown that they can control, which I think is great for the US. As a 4D chess move by Trump, either they get the best chips in the world and we make 25% on it, or they use inferior chips and US continues to be the leader in AI.
Yeah.
Brilliant freaking move.
I love it. I think it's great, but look. So I think what's going to happen is you're going to see a lot of these, because look, if you look at some of these AI startups, it doesn't make sense. They have a concept that you think, well, where's your revenue model? You haven't even got a revenue model. It doesn't make sense. I mean, okay, you're doing cool shit, but how do you commercialize this? Half of these firms haven't even got to that point. So I'm like, this is, unless I'm taking crazy pills, if you don't have a route to profitability, eventually you're going to run out of cash and go bust. Doesn't matter who's backing you. So I think there's going to be another cohort of VC investors that would have deployed into AI, which will look at it and go, Jesus, maybe we hold creates is businesses potentially like ours that have been, okay, we haven't been trading a huge amount of time, but you know, we've been growing our revenue on an annualized basis by over 100%, you know, growing our profitability over 100% over the last couple of years, which is, I think, pretty good growth. And I think that will continue. That makes us a very, very key contender, I think, for this very large amount of cash. So could that potentially happen in the next 12 months? Yeah, I think there's potential for it, absolutely.
Yeah. Now, going back to that correction, Penguin here asks, and I wanted to expand on this a little bit more. Next year, we're going to have a big correction, question mark. So when you say big correction, meaning big pullback, like we saw a big correction in 2017, early 2018, like Bitcoin reached its peak December 2017 and then had a big correction down from there. 2021, we saw a big correction after a really big pump. Are you saying that Bitcoin is going to correct down from here, or it possibly might go up, but then correct down, kind of going along with what used to be a 4-year cycle, but this year seems to be playing out more over 5 years?
Yeah, so look, I think between now and the end of the year, I think there's a very good chance we will see a bounce back. Probably to, I mean, I don't know. I don't know whether 200-day simple moving averages, but it's maybe about 107, 100. I don't know. I'm off the top of my head, I'm not sure. So 107 to 108,000 roughly. So I would say that's a reasonable target between now and the 29th of December to kind of get to. I'm hoping kind of gets back to that level. I hope it does, because I want to sell a bit more, just a tiny bit more. And then I've reached my actual exposure by about 50%, which then if I'm wrong, then at least I've got half of bloody Bitcoin, right? So I think in January, maybe February, and it could be March, I don't honestly know, but at some point we're then going to see, I hope, maybe a bit of a slow grind during the course of the year down, and then we're going to kind of see stabilization, and then probably middle of 2027 we're going to see this begin to bottom out and then bounce aggressively to the upside again. That's kind of what I'm hoping for, but I genuinely don't know. I mean, look, this is the adding conundrum we have that you've got to think about as well. So next year is the start of the war cycle, and what I mean by that is that if you, in fact, sorry, Jay, back to your point, you know, is this like 2017? No, I think it's going to be more like 2014. So 2013, we saw, again, new all-time high for Bitcoin. 2014, we saw, well, a bit of a calamity. So, but I think it's going to be more in the lines of a 2014 correction than a 2017 correction, if I'm being very honest with you. So I think it's going to be, the 2017 correction wasn't quite as it wasn't quite as long in terms of duration. It was quite profound, but it didn't last quite as long. 2014 just went on and on and on for a long time. But because we're entering the war cycle, I think we're going to see some not great things. I think we're going to see escalation of geopolitical tension. I think we're going to see a whole bunch of escalations across the globe. I mean, you know, if, for instance, Trump decides to go for Venezuela, I can guarantee the Chinese will say, screw NVIDIA, we'll just take Taiwan, don't all the chips. I mean, I think that's probably what they're doing, because the reality is that, you know, realistically, can the US have multiple fronts in this particular war? I don't think so.
Yeah, interesting thought. So what's funny about Bitcoin's price is a lot of the gains are already made, right? So where you make money on Bitcoin, it bottomed at 14,000. Like, it's way up. Now, I still think it'll hit at least 150 to 165K. And if we have a super cycle hit above it, but from here to there, it's already experienced most of its gains. Like say 165 is the top and you sell at 105, it's like, okay, you sold a little bit early, but most of the gains were made. Say you're buying at 25, you made a 4x up, and at best you were hoping for it to maybe almost go up another 50%. So it's like the gains have been made. Has ETH made its gains? I don't think so. I think
no,
some
no one did. I think, and I think if you look at what happened, when was it, 5.5 weeks ago, when we saw that 18% collapse of Bitcoin over a 24-hour period. I mean, first and foremost, ETH was barely 7. Well, I'd say barely 17, but it was 16 3/4, whatever it was. What was interesting about it was within 24 hours, ETH was back to where it was 2 days before. Bitcoin just kept on falling. That was just after the all-time high that we made. I was really hoping we'd stay above 110 and test 135, maybe 140, but yeah, we didn't. So I'm hoping that we test at least 107. If we can get to 115, 120, that's awesome. That's genuinely spectacular. I really hope we can do that between now and look. All I would say is between now and the end of the year, it's going to be super volatile. So you can't discount anything. I think there's definitely a possibility that happens. What is the probability? I think there's probably, look, there's a 75-80% probability we get back above 100. I think, do we test the previous all-time high? Probably 15%. I'm not sure. That kind of broad order of magnitude in terms of where that goes. I fully agree with what you mentioned before. Within 24 months, we're going to be at 250K. Unfortunately, I think we may go via 70 or 60 before we get there. And I can guarantee what's going to happen. I've got friends of mine, and I did tell them, they called me the day of that all-time high saying, hey, I bought some Bitcoin. It's like, why? Why would you buy at this level? It's like, they're like, what are your clients doing? It's like, everyone is dumping the shit out of this. Why would you buy here? They're like, why? They're like, it's all over the news. It's like, that's the reason to sell. That's not the reason to buy. But these are the same people, bless them, that will basically be dumping at 60, and then it'll probably be hit 59 bid and then go straight back to 75, and they'll be like, oh, that Bitcoin trade was shit, and 12 months later it'll be 250, 300. So where they'll probably buy again. So they're wonderful reverse indicators, but I think, I don't know what to say to these people. I'm not, this is, by the way, it's not financial advice. This is just, I'm just sharing my thoughts on people's behavior. I don't know what to say. It's kind of nuts.
That's what I spend my channel trying to help people understand, is not to be that guy, but that is not almost 95% of people who get into crypto and like, crypto's a great thing. I just watched CBS talking about it or something. There's some news station, the BBC, talking about what a great buy Bitcoin is like, that was an amazing sell signal, not a buy signal. Yeah, but they said it's great. That only happens at the top.
I think it's funny, unless you've lost a lot of money. I'm embarrassed to say I've lost a lot of money. I've been scammed. I was scammed in 2017, like the idiot that I was at the time. Someone copied a friend of mine's Telegram handle and said, "Hey, can you lend me some ETH? I'll send you Bitcoin as collateral." I was like, "Hey, no problemo." Sent the ETH, sent me the Bitcoin. And then later on the day, kind of pinged him, say, "Hey, that Bitcoin transaction failed for some reason. That's weird. The profile's deleted." I was like, "Oh shit. Just been scammed." What was Bitcoin then? $90? No, sorry, ETH. $90. Yeah, $90, $100. Yeah, it's a lesson I learned there. And then also, MetaMask getting hacked, which is why I'm so focused on custody. Just and I guess once you've gone through the journey, you've taken a kick in the nuts several times because of shit like this. You become acutely aware that you've got to focus on security, and I think that's kind of why we're kind of wedded to some of the people that we work with, because they're good at what they do.
Another question here from Jackbird. The repo product will be huge. Do you think MicroStrategy will be a customer of DeFinity for this product?
It's a good point. I mean, I guess they're already long. So the reverse repo business is effectively aimed more at the pension funds and the people lending into the digital asset space than the people that are long with Bitcoin, because the coupons are skewed towards those kind of counterparties. So effectively, it's kind of aimed more at essentially funds that come month end or quarter end, need cash because they've got to pay for shit, but they don't want to sell because why would they? they're the kind of demographic we're going for. With MicroStrategy, because effectively their operating model is slightly different. I mean, they're basically just a leverage ETF is how I see them. Would they be willing to pay those amounts of cash to borrow? I mean, maybe, because I guess it's a 10% annualized coupon. You know, so the earn rate's not that high. Maybe, yeah, that's an interesting angle. I hadn't thought of that.
Another question by Chris said, originally you had said you were hoping to get acquired by a big company. Is that still your desire? And if that happens, what protections do token holders have in that scenario?
Okay, and again, the way I look at this is that, and again, it's maybe just the kind of view that Chris and I and Michael's managed the business have, is let's say, let's fast forward to next year, right? Let's say the market cap of the token is $10 million or whatever it is, yeah? And let's say that the valuation of the business is 100 million. Well, I look at that and say, okay, is that any different to a business that has got, let's say, a $10 million loan and a valuation on the equity of 100 million? Not really. You know, in order to basically buy that business, what's the value of that business? 110. Either the enterprise value of that business is 110, or you take the 100 mil for the equity and then you purchase the tokens for that 10. So if there's an equity cash exit, what will happen is that whatever price we have on a given day for that token will be fixed. And then effectively there will be a bunch of OTC deals where you send me token, I send you USDT or USDC, whatever you wish. And that really is, I think, the only fair way to deal with it. Because look, you could do things like a roll-up, you could do basically swaps into equity, but again, that's a much lengthier process potentially. So if that's something that you want to do, probably best you do that now rather than at that point. But that's kind of how I see the exit happening. And then again, here's the other thing to bear in mind. If DMA DeFinity is sold tomorrow, don't forget that the native token for all rewards for Bloomsbury will be the DEVVE token. So there will still be a use case. There will still be something. So for instance, if you want to benefit with discounts, and these are discounts on actual banking fees, you've got to hold a certain amount of DFX. Now that isn't going to go anywhere. That's going to stay in place. And effectively the exit on DeFinity/DMA, that's going to happen far earlier than Bloomsbury is going to take much longer to scale just because it's a banking business. You know, most fintechs, you're talking about 5-6 year cycle. With a banking business is more like 10 to 12 years. So they're different beasts that kind of will grow and scale at different rates, basically.
You mentioned before the fees and stuff for the gambling, where it's like, okay, $10,000 worth, and you get, you know, basis points discounts. Can you talk about the fees and utility for DeFinity in Bloomsbury Money and how much people might save with that?
Well, it's a question of a couple of things. So for instance, let's say you want to have just an account where you can potentially on-ramp, off-ramp, whatever you wish within the app, super fast. Effectively, there's no minimum amount. So if you look at the transactions we do, just because of the nature of the business we have, if you know our minimum trade value is $100,000. So if each individual trades less than $100,000, we just don't do it. It's just too much hassle.
Yeah.
Which again, I get a lot of criticism from people saying, well, if I do 10 trades of 10K, then that's 100K. And it's like, yeah, you know, we're kind of more wholesale, more institutional. So really, it just doesn't quite work for us. Now, we should probably think about changing that because actually there's a huge cohort of potential clients that we could look at. And again, you know, having a look at the combination of the banking fees and the trading fees, we probably could do that actually. So, you know, there's large demographic clients that we've spoken to that want to trade with us. We've just said no to just because it's been too challenging for us. Just operationally, the trades are too small. Now, with the opportunity in Bloomsbury, suddenly that becomes much easier to do because actually everything's fully electronic, everything's within one ecosystem, it's much easier to manage, and actually there's no minimum transaction value. So the fact that you get access to a platform that's making prices for institutions is the first benefit. The second thing is that unless you've got net tangible assets of $25 million, you can't access this anyway. So it opens this up to anyone who holds a certain number of DFX tokens. And again, in terms of the fee structure that we have for Bloomsbury, it's on the website, so you can go to bloomsburymoney.com. Because of the nature of digital assets being a high-risk industry, the fees are very high. So it could be the case that you're paying, I don't know, 1% or something. So let's say you're trading $1 million. You may be charged $10,000 to do those trades, i.e. to receive funds into your account and then do the transactions. Obviously, if you're a low-risk firm, like an accounting firm or a law firm, well, you'd be paying, pennies on the dollar, basically. It's bugger all. It's very, very cheap. But it's all kind of set to risk profiles. So what it means is that, whilst we have an offering, we've got to be mindful of the fact that it's high risk for a reason. And it's high risk because there are all sorts of potential consequences. There are all sorts of issues and risks that we are taking by running that bank that could obviously end very badly if we make the wrong decisions, if we onboard the wrong counterparties, if we do business with the wrong kind of people. So again, we're mindful of the potential operational risks, the financial risks, the criminal risks, if we do business with the wrong people as well, that we all face, which is kind of reflected in the price. So again, very, very high level, broad brush, but let's say that you're a high risk industry and you're paying 1% of flow fees, i.e. 1% to receive funds in. If you have to hold a minimum amount to basically get a discount, that's a huge saving. And again, as an individual, you would not be able to access this anyway. So it's something you can access that has great pricing that you can trade for, not necessarily free, but almost free in terms of you'll be getting the cost price from us anyway.
I feel like a lot of us kind of live in these like fish bowls where we, everyone around us is making, let's say like, they'll make between like $80 and $250,000 for the most part, like in the world. $1 million, $1 million transaction, that's a lot. But when you're talking about the fact that you don't really do any of those transactions under 100K and you're dealing with the ultra high net worth individuals and institutions, it's probably not uncommon to see a $100 million transaction. And if they're in a high risk industry and it's 1%, that's $1 million fee, which is nuts. Yes. And to be able to save a bunch of that just by holding DeFinity, I think is really great. So for those fees that you guys are making, is there a certain percentage that's earmarked for buybacks? Or is it just like at the end of each quarter, whatever we have left over, a percentage of that will go to buybacks? I was just wondering how that works.
Yeah, that's a good question. So this is a debate that me and Chris have on a regular basis, which, to be honest, is a debate that goes on for a lot longer. When Chris got a view about how we should do it, and look, my view on this is very, very different to his. Mine is like, look, let's keep it nice and simple. And the way in which we should do this is, and again, this is different for individuals versus corporates, right? So as individuals, you have to hold that balance. And by holding the balance, you can't get access to free banking, right? Which I think is a fair trade-off between the two. As a corporate, what happens is that obviously the discounts are not as high. So we're not going to give people free banking if they're a high risk industry because that makes no sense. Let's say they're trading $10 million. That's 100K of fees. I'm not going to give them 100K of fees for holding 10K of assets. That makes no sense. So the way we'd look to do this is that it wouldn't be 10K. It would be, let's say their fees on an annualized basis are, I don't know, $1 million a year. Okay, so let's say they want to have a discount on that $1 million. If you hold $50,000 of token, we'll give you basically $100,000 discount on the fees. Now, as a percentage, that might not seem like a huge amount, but effectively they're getting double bubble basically for holding 50K worth of assets. Obviously, I can't do that today because the market cap is too bloody low, but that's kind of where we're going to be pushing this very soon. And again, look, we've only just launched, so we have the initial cohort of a couple of dozen test clients that are kind of messing around with the system, trying to break it, which one of them did last week, which I'm very grateful for because we've now fixed it. Nothing major, just yet. I mean, they were like, "Oh, your Aussie dollar versus Canadian dollar doesn't work." I'm like, "Who the hell trades Aussie CAD?" Jeez, okay, yeah, fine. So there's a hole in our pricing. We fixed it. But yeah, we're trying to get them to see if they can break the damn thing, and if they can, great, we can fix any issues. But at the moment, it's just to test the friendly clients that we're kind of moving with, and then next year we will be launching our full tech stack. Our full tech stack will be launched. I can't disclose quite where. It will be offshore. You can probably guess where that might be, and that will be very interesting as well. That'll be a very, very interesting offering, specifically for high net worths, for trust companies, and for funds that are offshore as well.
Well, we've got to wrap up here, and we're going to jump into a second call. This is for the private Discord members. So if you haven't joined the private Discord, you can get access to private calls there. Manu, thank you for extending this time with everyone. And I had great questions along the way. Thank you for your engagement, everyone, and the good questions that you've asked. Manu, thank you for joining us. I will send you another link for the next StreamYard call that for those in the private Discord, you'll be able to link into it from the Discord. Thanks so much. We'll see you all in a minute.
Awesome. Thanks so much, guys. Cheers.
Bye, everybody. This has been awesome.